What is working capital and why is it important? Working capital is the amount of money you have available to spend after you've paid for all your bills and other responsibilities that you're obligated to pay. These payments are anything your business needs to operate smoothly, like salaries, rent, supplies, and electricity. The formula for working out your working capital is current assets minus current liabilities equals working capital. But what exactly are current assets? Of course, these are your company's actual profits. But what if you have supplies or inventory that have not yet been purchased? Or you have an order that was delivered, but you're still waiting for payment from the customer? These have value, but are not in cash form. Are these also defined as current assets? The answer is yes. All these items that are not currently in cash form, but can be converted into cash relatively quickly, and will do so at some point, are considered current assets. What then are current liabilities? These, of course, are expenses like electricity, rent, supplies, shipping, and anything else that if the company didn't pay for immediately, the company wouldn't be able to operate. But what if you received supplies for production, but requested from the supply company to pay for them later? Or you have a monthly payment of interest for a loan that you received for the purchasing of equipment? Are these debts also included in the calculation? The answer is yes. Current liabilities are any outstanding debts or payments that the company needs to pay for. For example, let's say your company makes a profit of $1,000 a month, but you have an inventory of your company's products waiting to be sold worth $500. In addition, you're also waiting for a client to pay you for a delivery, also worth $500. Your total amount of current assets would be $2,000. Next, your total monthly expenses for electricity, rent, salaries, and shipping comes to $500, but you also have to pay for the supplies your supplier allowed you to pay for in a month from now worth $200 and a loan totaling $200. After having paid interest every month, your total amount of current liabilities would be $800. Calculating your working capital would be current assets, $2,000, minus current liabilities, $800, equals $1,200 working capital. But what's the importance of knowing this? The calculation is how you and other parties, like investors and lenders, evaluate the health of your company, not just for the short term, but also for the long term, at least a year into the future. If you have a positive working capital, meaning you have money available after your current liabilities have been deducted, your business is in good health, and investors will be more willing to part with their money, and lenders more willing to extend a loan with more favorable terms. Knowing your working capital and calculating it is like visiting the doctor for a checkup. You'll know if you're doing well, or you'll know that adjustments are needed to improve your company's health. For more information on this subject, please visit our website at www.finimpact.com to read the entire article.